Church Gateway. This is the Gateway Evening with your CEO, Pastor Po Seng. Let's welcome our host for the night. A round of applause, ladies and gentlemen.
Yes. Looks like there are a handful of people in here. Just a handful. All right, we have our production crew and all that. They are here. Tonight is really special. As you know, the church has become so versatile, right? 1 week we were here live, physical in church, fellowshipping and listening to the Word of God. But tonight, all right, because of the surge in the COVID cases, we thought that to be prudent, we should not do a physical church, but to really just do a Facebook live streaming, right? So I really want to thank the crew. Those of you who are here, braved yourself to come. You know, the sound room people, the audio-visual volunteers, and those of you who have come in for ushering and all that, right? Just want to honor you guys for doing this. All right, can we give yourself a big round of applause? Yourself, come on. Woo. Okay, there's going to be a lot of talents tonight. All right, we have very young talents coming in our church today. We're going to start off actually with Ian, and later, you know, we're going to have Andrea preach the word as well. So tonight is really going to be so special. So I really want to invite Ian to just come up. Ian is not new to us. Ian's been attending Ammunition Gateway for a long time. And he has spoken here before, and he's a smart investor. All right, he's a very smart investor. Smarter than me, because I always lose money. My wife always tell me, you always lose money when you invest in equity. So tonight I'm going to listen very carefully to this young man, all right? And I want to encourage you to do that as well. Bring out your pens, your pencils, or your notebook or something, sharpen it, and then we'll see, take notes, and then we'll see what we can ask him later, all right? All right, so we're going to invite Ian to come over and take a seat here. Maybe we'll just ask him to introduce himself. But tonight you really look, wow, you really look like an investor, I must say. You know, is that how you always dress?
No, of course not.
No?
No. I'm more casual than this, lah.
You're more casual than this. All right, good. I was a little bit intimidated, you know, when I saw you, and I'm like that. You know. So anyway, Take 1 minute and kind of introduce yourself, what you do. Who do you represent, and how long have you been doing this business of yours?
Well, of course, I intend to actually give you my introduction in the slides later. But since Pastor, you asked, right? So of course we can bring it forward. So I'm a content producer for kclaw.com, where we are all about financial education. So anything related to money, like how do you save money, how do you invest your money, and how do you protect your money, right? So all these subjects, we will cover them. I will be personally writing all these articles. And every week we are going to do weekly webinars, all right? So it's every Tuesday where we have different subjects about money, and then we will talk about them in our platform, kclaw.com.
Everything you need to know about money. I'm really excited with that. I'm really excited with that on Facebook Live, all right? Just give us some love emoji coming up right now, all right? If you have any questions, get ready, and please write it down in the comment chat, okay? All right, so I think we've got the right guy up here for this, and so I'm going to now leave it to you to take the floor.
Yep, sure.
Thank you, Ian.
Of course, it's such an honor to be here, all right? Although there's not many of you physically present, but I'm sure that most of you are actually watching online. So thank you so much for doing that, being here with us today, and it really means a lot to me, all right? So over the next 20 to 30 minutes or so what I will do is this. I'll be sharing with you a very simple battle plan, which I have personally use to invest profitably and confidently in any economic conditions. So this is the topic for today, and let's get right into it. All right, so basically, I have actually just given my introduction. So now I'm going to just give it a little bit more elaborate, do it a little bit more elaborate than just now. So just now I have actually introduced myself. I am actually the content producer for kclaw.com, where we talk a lot about financial education, but also with my boss and my partner, Casey Lau, both of us, we have founded a website called dividendwalk.com, and dividendwalk.com is an online membership site where we transform people who knows nothing about stock investing. That means people who are very new to stock investing. And what we do is that we transform them via education to become someone who is competent to invest and build themselves a dividend-based portfolio that pays them dividend income year after year. And with that said, of course, I myself am also a dividend investor where I primarily invest for dividend income. So which means when I invest in the stock market, I'm looking for dividend yields. And currently, I have built myself a dividend-based portfolio where I'm earning somewhere between 4 to 8% in dividend yields per annum. And when it comes to real estate, I would not consider myself as a veteran. I'm still learning about real estate investing. So at this moment, I have bought myself 2 pieces of properties where I bought them at prices somewhere between 11 to 12% below their current market valuation. Both properties are currently untenanted, and of course, I have just completed one renovation, and currently I'm still finding tenants to occupy both of these properties. So this is who am I, what I do, and my current status as an investor. All right, so now let's talk about the better plan. So in order to do that, for today, to talk about the better plan, I'm going to refer to the story of Joseph. And this story can be found in the book of Genesis in the Bible, where, as you know, Joseph, all right, so he is one of the 12 sons of Jacob. And then he was betrayed by his brothers, sold into slavery, and then he was then falsely accused by Potiphar's wife, and because of that, he was put into prison for a crime that he did not commit. And after many years sitting inside the prison, the Pharaoh one day summoned him to meet him simply because the Pharaoh needed him to interpret his dream. And after Joseph has successfully interpreted his dream, the Pharaoh then instantaneously promoted Joseph to become the Prime Minister of Egypt. And as the Prime Minister of Egypt, Joseph then helped the Pharaoh to become the richest man in the kingdom of Egypt. And all these things happened during times of famine, which is kind of like what we are experiencing today. All right? And it's actually from this story, all right, that I've formulated a simple battle plan that I use to invest profitably and confidently in any economic conditions. And I believe you can do it too. All right? So over here, in the next 20 to 30 minutes, I'm going to summarize to you 5 points. 5 points that you need to know to build yourself a sustainable investment portfolio. So let's get into point number 1. All right, so this is point number 1, where I'm going to talk about the first mentioning of economic cycles in the Bible. So in order to do this, all right, I'm going to refer to the book of Genesis, chapter 41. So before I continue, let's follow the story. So Genesis chapter 41, verse 29, it says, 7 years of great abundance are coming throughout the land of Egypt. And verse 30, it says, but 7 years of famine will follow. Verse 31, then all the abundance in the land will be forgotten. Verse 32, the matter has been firmly decided by God. So what does it mean? Well, let's start off with the 7 years of great abundance. So this thing here, 7 years of great abundance, refers to the good times. And then we have the 7 years of famine, which refers to the bad times. And ever since then, the economy has been working in cycles. It has been moving from the good times to the bad times, from the bad times back into the good times, and so on and so forth. Okay? But here's the thing. In verse 31, it says, then all the abundance in the land will be forgotten. And the key word here is forgotten. Why? This is because for most people, people tend to forget that the economy works in cycles. Now here, let me give you an example. All right, let's say, for example, we have the economy and it is doing well. During these times, when the economy is doing okay, people tend to forget about the bad times, and therefore, they did not make any preparations for it. And now, let's say, for example, the economy turns bad. The economy is not doing as well. What happened is this. People tend to forget that there is such a thing called good times. And because of that, people tend not to invest their money to capitalize on it. All right? So good times, they forget about the bad times, and therefore, they do not prepare for it. Bad times, they forget about the good times, and therefore they do not invest their money into it. But here's the thing. In verse 32, it says, the matter has been firmly decided by God. So the matter here refers to the economy cycles, which is moving from the good times to the bad times to the good times. Firmly decided by God means these things are already a certainty. So what does it mean to investors? It means that in our lifetime, as investors, we know that we are going to experience both the 7 years of great abundance, the good times, and as well as the 7 years of famine. All right? So instead of us trying to figure out, where the market is going to go in the future, right? I would say it would be more practical for us to build ourselves an investment portfolio that can not only do well in times of abundance, which is the 7 years of great abundance, but as well as to survive and thrive during the 7 years of famine. So good times doing okay, bad times also can survive and do even better. So that is the main point here, how we build an investment portfolio. That's the mindset. Okay? So now how are we going to do that? And this leads us to point number 2. So point number 2, I'm going to start off by talking about the good times, the 7 years of great abundance. Okay? So over here, I'm going to introduce to you a simple principle. And this principle is known as the 1/5 principle. So what is this all about? Well, before I go on, let's follow the story. So this is Genesis chapter 41. And in verse 34, it says, let Pharaoh. So this is Joseph advising the Pharaoh. So it says, let Pharaoh appoint commissioners over the land to take 1/5 of the harvest of Egypt during the 7 years of abundance. This food should be held in reserve for the country to be used during famine. So this is very simple. In essence, the 1/5 principle is about saving 20% of your income, which means today, if you are making $5,000 a month, then you should save $1,000 a month. If you are making $10,000 a month today, then you should save $2,000 a month. And that's it. That is that simple, how to invest during good times. But here's the thing. As simple as this is, during good times, this 1/5 principle is very hard to follow. Why? This is because during good times, people's confidence level tend to go on the high side. All right? People tend to be more confident. And when that happens, people tend to do 2 things. Number 1, people tend to spend money, or they will borrow to spend even more money. For instance, okay, when the economy is doing well, people can get more loans simply because their incomes are rising. And because of that, because they can take loans, they can either choose to buy themselves a new car or a new house. And this is actually very common during good times. And number 2, if let's say they choose not to spend money and they choose not to borrow to spend even more money, what they will do is this. They will choose to invest their money. Why? This is because, let's say for example, today you listen to me talk and you say, 1/5 principle. Take 20% of income and put into some bank account or some FD for your reserve. What they will think is this. You say, money in the bank account, all right? FD, all right? Putting money into FD is idle money. It is money that is doing nothing in the bank because the interest rate is very low. So what they will do, how do you actually grow your money, all right, faster than FD? Here's what they will do. Here's what they will think and they will do. Number 1, they will take their money, they will start to invest in a new business. Or if they are already a business owner, they will take this money to expand their businesses. All right? And this will actually spread out their resources even thinner. Okay? And let's say, for example, if they are not into businesses and they have excess money, what they will do is that they will take their money and invest into the stock market. They'll buy stocks in the stock market. And number 4, they will take this money, right, and they will go and buy properties. And what happens is this. This will cause stocks and properties, their prices, to go up and become more overvalued. They'll go from undervalued to become overvalued. So what do we do in this situation? Okay, well, if you ask me, if let's say I like a stock and the stock price has gone up and it has become overvalued, so what do? The answer is very simple. It is to do nothing, all right? Do nothing. You don't need to chase for all these kind of gains. So when I see the stock price go up and it becomes overvalued, all I do is that you just continue to apply the 1/5 principle. Save money, all right? Just hold it as reserve, okay? And that is what you need to do. That's it, all right? So this one is not so much about action plan. This one is about emotional control, because people tend to have this tendency to always want to do something during good times. So just play cool and apply the 1/5 principle. So now the thing, here's another question I would like to ask, which is, okay, since overvalue you cannot buy an investment, then when would an investment become undervalued? When would an investment become undervalued? Now let's go into the next point, which is point number 3. Okay, so point number 3, just now we talked about the good times, the 7 years of great abundance. Right now we are going to talk about the bad times, the starting point of the bad times, the 7 years of famine. Okay, and of course, before I explain further, let me just quickly read to you Genesis 47. So let's follow the story. So Genesis chapter 47, verse 15, it says, all Egypt came to Joseph and said, give us food. Why should we die before your eyes? Our money is used up. 16, Joseph said, I will sell you food in exchange for your livestock, since your money is gone. Verse 17, it says, so they brought their livestock to Joseph, and he gave them food in exchange for their horses, their sheep and goats, their cattle and donkeys. Okay, so here there are a few things that I would like to highlight to you. All right, so this is what will happen during the starting point of a famine. All right, there are 2 things. Number 1, people may either lose their jobs, or they may receive a pay cut. Or if they are into, number 2, if they are looking into businesses, or if they are already into businesses, they are business owners, what happens is this, they may experience a slowdown in their business. So in both of these cases, their incomes are affected. And what they will do is this, okay? If let's say their incomes are affected, they will start to take from their savings, all right? They will take from their savings to sustain their current expenses. And if let's say they happen to run out of money, okay, like what the Bible says, our money is used up. So the next thing they will do is that they will start to take their liquid asset, okay? Anything that is, or you can call it movable asset, liquid asset, movable asset, or current asset. They'll take this asset, they'll sell it off, they will convert into cash so that they can tahan or sustain even longer. So over here we can see that in the Bible, what exactly is a liquid asset? Over here they give us an example, which is livestock. So liquid assets are livestock. And in Bible times, we have horses, their sheep, their goats, their cattle, and donkeys. Today, in the modern context, what is our liquid asset? Okay, for instance, we can have, if let's say they are not into stocks, then of course they may say, my car, my BMW, my Mercedes-Benz. Business cannot tahan already. What for? Keep this Mercedes-Benz. Sell it off first. Reduce your commitment, right? And over here, of course, if let's say the business owner or the employee happens to be a stock investor, they have no choice but to sell off their Maybank, Public Bank, CIMB Bank, Carlsberg, Heineken stock, whatever they have in their investment portfolio, they have to sell it off because they have no choice but to survive. All right, so you can say all these horses, sheep, goats, cattle, donkeys, it's like Maybank, Public Bank, Carlsberg, Heineken, Dutch Lady, and so on and so forth. So this brings us to our next question, which is this. Okay, let's take a moment and think about it. What is the price? Okay, let me repeat to you. What do you think is the price Joseph would have paid to buy over all the livestock owned by the Egyptians? Let me put this into perspective, okay? So on the left-hand side, we have the buyer. And on the right-hand side, we have the seller. So on the left-hand side, we have buyer, right-hand side, seller. Buyer, one man, Joseph. One man only. This man, very cash rich, lots of money. Okay? On the right-hand side, we have sellers, all right, which represents the Egyptians. How many people? Many people. No cash. Very desperate for cash. Okay? So what do you think is the economics of this livestock? All right? Can you see that the economy is actually working for Joseph, but is against the Egyptian? So I submit to you that it is very much possible for Joseph to have paid a very huge discount to buy all the livestock owned by the Egyptians. And that is why, if you want to invest in good stocks, the best time to do it is not exactly at the 7 years of great abundance, but it is actually at the times of famine, the 7 years of famine. All right? So that is about the starting point of the famine. Now I'm going to go into the latter part of the famine. And this brings us to our next point, which is point number 4. All right? Where we are going to talk about properties. Okay. So now, before I continue, let's just follow the story. So this is Genesis chapter 47, and here it says, verse 18. When that year was over, they came to him the following year and said, verse 19, our money is gone, and our livestock belongs to you. There is nothing left except for my land. Buy our land in exchange for food. So Joseph bought all the land in Egypt for Pharaoh. Okay, so over here, I'm going to share with you two things, just two things. Number one, that year. So that year refers to the point where I have just spoken. It's point number 3, when Joseph bought all the livestock from the Egyptians. So that is that year. Can you see the next one, which is following year? So we have that year, and 12 months later, we have the following year. Okay? So this actually represents a time lag, all right, which is a time difference of 12 months, more or less, between a stock market crash and a real estate crash. All right, so how can this apply? How does this apply to us today as investors? Let me put this into perspective. Okay, so here is not an absolute, but let's just take a moment to think about it. Let's say our starting point for that year, okay, is the recent stock market crash in March 2020. And from March 2020, we add 12 more months. All right, we add 12 months forward to March 2021. So the question is this: is it possible for our property market or our real estate market to remain depressed in year 2021? So what is the answer? Well, it really depends. It really depends on the people's financial power, the financial ability to hold on to these properties. Okay? So here it says, let's say after selling off their car, their stocks, and everything they can sell off, okay? Anything they can pajak, they pajak already, okay? And their money, whatever they have collected, all used up. All right? Then, of course, the property market will remain depressed because they have no choice but to sell off the property. All right? Another angle of looking at this is this. So we have March 2020, all right? And that also happens to be the time when our government started the MCO and as well as the loan moratorium. And we were given 6 months of loan moratorium where we do not need to pay the mortgage. Today, as I speak, we are starting to pay our mortgages. Okay? So let's see how long we can tahan lah. So if let's say the people can tahan, then of course our property market can remain stronger lah. But if let's say the people cannot tahan, all right, now there is no more loan moratorium. People are now starting to pay all the mortgages. And let's say people find it difficult to pay and service all these mortgages, then we will have a problem. All right? then of course these property owners will have no choice but to sell off these properties or their properties at discounted prices, which is a very good news to all investors, especially if you are looking to buy yourself an investment property. Why? This is because during these times, we can actually buy properties at somewhere between 10 to 20%, depending how good you are as a negotiator, or how good you are in finding your or let's say, let me put this another way. It depends on, number one, how good you are as a negotiator to negotiate for your discount, or if you are not such a good negotiator, then it depends on how good your agent is in finding you these discounts. Okay, that is what I'm trying to say Okay, so in the sub-sale market or the secondary market, in any ways, you can get somewhere between 10 to 20%, or maybe a little bit more, all right, from the current market valuation. But if, let's say, you're looking at the auction market, maybe you can get a better discount. Your discount could range somewhere between 20 to 40% below the market valuation. So as you can see, this is what happens. This is what it says in the Bible. During the 7 years of famine, all right, you find that Joseph actually bought all the land in Egypt for Pharaoh. And you will not see Joseph in the 7 years of great abundance going about trying to find real estate. It doesn't say that. Or at least I couldn't find it in the Bible. All right? You only find that Joseph buys properties, buys land during the 7 years of famine. All right? So now here's the thing. Buying land itself. Now, Joseph had the livestock, and now he also bought land. But does that make Pharaoh a rich man? The answer is not yet. And this will actually, I will bring you to the next point, all right, which is point number 5, okay? And before I explain any further, let's follow the story. Genesis chapter 47, it says, and this is verse 23. So it says, Joseph said to the people, "Here is seed for you so that you can plant the ground." 24, but when the crop comes in, give 1/5 of it to Pharaoh. Now over here, you can also say that in the Bible, right, this is also the introduction of income tax stated in the Bible. Okay, this is the first time. So today, corporate tax is more or less around there, that range, 17% to 24% in Malaysia. So it's more or less there, okay? It has some resemblance. Now let's move on to verse 24. It says, "The other 4/5, you may keep it as seed for the fields and as food for yourselves." Okay, so here I'm going to also talk about two things. The first one is plant the ground. So here it talks about the income generating ability of an investment. Okay? So the question is this: how do you find good investments? How do you know that ABC Berhad or ABC Limited is a good stock to buy? So what's my answer? Very simple. It all depends on the income generating ability of ABC Berhad, how well it delivers its profits to its shareholders. So if I want to find out whether or not ABC Berhad is worthy for me to take time to study and invest into it, I will look at its annual reports, its financial accounts, to find out about its income generating ability before making an investment decision. What about properties? Well, the answer is this: can you rent it out or not? Can you rent out your property and achieve a very good rental yield that is worthwhile for you or not? So all these things here is about cash flow, okay? When it comes to stocks, we look at its cash flow, income, cash flow. Property is also the same. We also look at rental income, all right? Whether or not it can pay or at least almost, all right, support the mortgage, all right, so that you don't lose the interest portion of the mortgage. So it's about cash flow. Very important. A lot of people actually forget about cash flow, all right? So this talks about cash flow. The second point that I would like to highlight to you is this: give 1/5 of it to Pharaoh. Now over here, this talks about, this to me, there's a lot of angles we can explore, but here I'm going to talk about the power of passive income. All right? So why? As you can see, in the last point, just now I have mentioned, Joseph had bought all the land in Egypt for Pharaoh. And now the Pharaoh owns all the land in Egypt. So here's the question. Do you see the Pharaoh taking up his golden changkul and start working on his land? Of course not, right? All right? Here what it says is this. Joseph, as the prime minister, he tells the people, the Egyptians, here is seed so that you can plant the ground. And once the harvest is there, take 20%. All right? 20% of whatever you produce, you give it to me. Income tax. What does the Pharaoh do? Nothing. Okay? He may be enjoying life in his palace. Why? This is because he has passive income. The rest of the people, active income. Okay? So that is the key thing here that I would like to share with you. So how do you actually become rich and wealthy from investments? How do you become financially free? The answer lies in how much passive income that you can generate today. Can your passive income support your monthly living expenses? So if you can, then of course you are financially free. And most likely, you are also rich and wealthy. Okay? And over here, there's also one final tip that I would like to highlight to you. It doesn't say what you know. This 20%, if you think about it, do you think that it's just a one-off thing? That means to say, okay guys, let's say I'm the Pharaoh or I'm Joseph, I tell the people, you know what? You go and plant the ground, all right? Whatever you have produced, 20% give it to me, all right? Is it a one-off thing or is it a recurring thing? That means every time you got a harvest, you give it to me. Every year got harvest, 20%. Next year, 20%. Third year, 20%. So how long is it? It's for forever, right? All right? It's for as long as he's on the throne, right? So that is called the power of cash flow. All right? Passive income for life. It doesn't say after Joseph has bought all the land from the Pharaoh, right? It doesn't say the Pharaoh take all these properties and flip it for substantial capital appreciation. It doesn't say that. It says 20% for life. And not only just his life, his next, he can also take this passive income, right, and pass it down to the next king, which is his son, his grandson, his great-grandson. As long as the kingdom of Egypt survives, his family will get passive income for life. All right? So this is actually the 5 points. And right now, I'm going to give you a case study where I'm going to review to you a personal investment of mine. But before I go on, right, let me just quickly summarize the 5 pointers to you. So point number 1, I have talked about the good times and the bad times. So therefore, as an investor, right, it is best to build a portfolio that is sustainable during the good times and as well as the bad times. Number 2, save 20% of your income. Apply the 1/5 principle. So let's say, for example, today you say, Ian, I'm not an investor. I'm not interested to invest in stocks or properties. So what do I do? Well, simple. This could be your take-home point today. Just apply the 1/5 principle. If you can save 20% of your income, right, I'm very sure that you are financially more well-to-do than a lot of people in this country who never really save 20% of their income. Point number 3, the best time to invest in stocks and properties is during the 7 years of famine, not exactly the 7 years of abundance. Point number 4, I talk about the time lag between the 12 months time lag between a crash in stocks and a crash in the property market. Okay? And point number 5, wealth from an investment lies in its income generating ability for the long term. Okay? And right now, I'm going to quickly go through my case study, which is DBS. And this is actually a personal investment of mine. So currently, I'm holding onto a stock, which is known as DBS Group Holdings Limited. So this is a stock listed in Singapore, and it is it is the largest banking group in Singapore, and as well as in Southeast Asia. Okay? So over here on the screen, I have reviewed to you my purchase date, which is on the 6th of April 2020. So this is just 1 month, or actually during MCO, when I got nothing to do at home, so I go and buy stock. Okay? And the purchase price was, before the brokerage fees that I pay, it's 18 Singapore dollars and 31 cents per share. So it's 18.31. Okay? And of course, before I talk any further, let me just quickly go through a small disclaimer lah, all right? Because I also scared someone say, "Oh, Ian say DBS a good stock, I also go in." No, that's not the lesson for today, okay? So that's why there is a disclaimer. So here there are three. Number one, the information presented is for educational purposes and does not constitute any financial, trading, or investment advice lah. And it is definitely not a recommendation for you to buy, hold, or sell any securities in the stock market. Number two, the presenter, and of course I need to protect Every Nation Gateway lah. So that's why Every Nation Gateway is also there. Do not accept any liability for all the information presented in the slides and during the presentation session. So don't come to us, all right, if anything wrong, okay? This includes but not limited to the accuracy and as well as the completeness of the information presented. And finally, number three, the presenter and Every Nation Gateway disclaim any rewards and risks arising from any investment or trading decisions that you make on the basis of the information presented. So which means if you happen to listen to this presentation today and you make money, congratulations. We won't take any commission from you. All right? Pastor won't get anything from you. I won't get anything from you. Which means also, but with that said, right, if you make a loss, right, then you bear 100% of the loss. Fair, right? 100% of the reward and risk you keep, okay? So that is our promise to you. Okay, let's continue. So over here, I'm going to quickly go to you two questions, okay? So there are two questions I would like to quickly answer to you today. Number one, why do I choose to invest in DBS? And number two, why did I buy it at 18 Singapore dollars and 31 cents on the 6th of April 2020? So let's quickly look at the first one. Okay, so the first one, just now, if you remember that I talked about the 5 points, right? So this is the time that I talk about point number 5, all right? How do you know that this is a good investment? Well, we need to assess it based on its income generating ability of the stock. So over here, I have plotted the shareholders graph, the shareholders earnings graph. And over here, what we can see is this. DBS Group has grown its shareholders earnings for the past 11 years at a rate of 11.5%, growing from 1.93 billion Singapore dollars, and that was 2008, to 6.39 billion dollars in 2019. So to me, this is a stock that I like because of its income generating ability. But knowing this is just one half of the equation, because knowing what to buy is just one half. The other half is what price. So how do I know that 1831 is a good price for me to enter? Well, let's move on. So this is actually the 5-year stock price chart for DBS Group, all right? So it is actually a graph from 2016 to yesterday, okay? And as you can see, at the yellow highlighted rectangular box, I put there 1831. So that was exactly the time that I purchased DBS Group. So now I'm going to explain a little bit about this chart over here. So can you see that let's start from 2016 to 2018. All right? So over here, we are going to use point number 2, the 7 years of great abundance. What do? You don't buy anything, right? Why? Can you see that the graph, it goes from somewhere between 15 Singapore dollars and it goes all the way up to 30 Singapore dollars. All right? So can you see there's a curve like this? When it goes up, right, for investors, we don't need to chase the stock. So this is the best time to just apply the 1/5 principle. Just save 20% of your income, put it in the bank account, and that money is for reserve. That's it. No need to do anything. All right? No need to trade. No need to do a lot of stuff. Just chill, save money. And Wednesday comes, come to church. All right? That's all you do, okay? Okay, next on. Now, can you see after it hits $30, it starts to drop to like maybe $25, $25, $26. So at that time, I didn't really purchase it lah. All right? At that time, I still continue to apply the 1/5 principle. And after that, can you see there is a sharp drop in stock prices where it goes from $25, $26 to about $17, $18. Okay? So that was the time. In Singapore, it's called the circuit breaker. In Malaysia, it's called the MCO lah. All right. So during this time, there are a lot of panic selling. And when that happens, right, it causes the price to drop from $25, $26 to $18, $17 or $18 somewhere there. But here's the question. Is this a good time for me to buy? All right, does that mean, oh, stock price drop? Okay lah, let's go in and buy. Does that really work for all investors? To me, not exactly. All right? Not everything that drops in stock price, you can buy. What investors will do is this. They will need to calculate the valuation ratios, all right, to verify that this drop in stock price, right, is a genuine discount. If it is a genuine discount, then we go in and makan lah, all right? And with that, I'm going to show you my next slide. So over here, I'm going to just put in some simple numbers lah. But don't worry. Today's session, right, I'm not going to explain to you how all these things work because there's another session where you can learn about this. Okay, but suffice to say, for me as an investor, I use three valuation ratios to guide my investment decision in any stock. So the first one is PE ratio, the second one is PB ratio, and the third one is dividend yields. So the key thing here is this. If let's say today you are here listening to my talk and my sharing session, and you find that, hey, Ian, I do not know what is this PE ratio, PB ratio, and dividend yields? Don't worry, which means to say you're not ready to enter the stock market. Because if you go in the stock market without knowing all these things, right, you are going to be seriously punked in the stock market. So I think it would be best for you to do the 1/5 principle first, save your money, go and attend some course, or maybe my future talk at kclau.com, learn about all these things first, then only you come back and invest your money in the stock market. So if you don't know, never mind. Just admit that you don't know and stay away from the market for a while. It's okay one, all right? But over here, let's say you know lah. Or if let's say you don't know, you just pretend to know lah, all right? So what I'm trying to say in this graph here, or this table is this. So on the 6th of April 2020, my buying price at 1831, right, is basically at these valuation ratios. When it comes to PE ratio, I'm buying it at 7.44. So PE ratio, 7.44. Typically speaking for investors, right, you're buying a world-class bank at 7.44 PE ratio. All right, that to us is actually super duper cheap lah. When it comes to PB ratio, you're buying it at, I have bought it at 0.96. So you're buying a world-class bank at below its book value. So this is actually a rare treat lah, from an investor's point of view. And last but not least, based on its last dividend payout of $1.23, my dividend yield at that time, I was expecting to get 6.72% per annum. 6% to those people who are in Singapore, and of course to some in Malaysia, DBS paying out 6%, this is like Christmas sales already lah. This is like unbelievable kind of deal. It's a no-brainer. So therefore you enter law, and I also enter law, okay? So this is the aftermaths, okay? So I purchased it at 1831. So currently I have received the following dividends. So I have Q4 2019. Q4 stands for quarter lah. The quarter 4 or the fourth quarter of 2019, 33 cents. Quarter 1 2020, 33 cents. Quarter 2 2020, I will be receiving 18 cents. Why 18 cents? Simply because the Monetary Authority of Singapore, or the MAS. So if you're not familiar about the MAS, it's like the Bank Negara of Malaysia lah. They actually give a friendly advice to all the Singapore banks, DBS, OCBC, and UOB Bank. They say, you know what? Last year, how much you pay in dividends, you cap it to 60% lah. We need to keep cash because we do not know when the COVID-19 will end. So it is to actually conserve cash to safeguard the shareholders of the bank. So therefore, I get lesser dividend income. This is not to say that there's a difference, you know. There's a difference between if, let's say, the bank is not profitable and cannot pay you dividends. It's a different thing than the boss, the MAS, tell the bank, say, you know what, keep cash first, all right? It doesn't say that the bank cannot pay. It just say please be hold for a while. When times are better, maybe you can resume back your dividend payment plan and stuff like that. And currently, the stock price, all right, I prepared this slide. I have edited the slides yesterday. So the stock price of DBS right now is 2071. And of course, if you want to know the latest stock price right now, you can always go to Google Finance to find out the latest price of DBS Group Holdings Limited. All right? So that's about it. That's my sharing session for today. Thank you so much for having me. And of course, if you have any questions, you can just direct it to or post it to ian@kclaw.com. So with that, let me just pass back the control to Pastor. Thank you so much.
Wow, let's give Ian a big round of applause for that. Come on, Ian, let's sit down for a while. Okay, so this is a good time to ask questions. All right, so Andrea.
Okay, I'm asking a question on behalf of the people online. This question is coming from Joseph. It says, would the low interest rates that NPLs hurt DBS and other banks' earnings? What is your thoughts on it?
Okay, I thought Joseph would know better, right? After all, he's the... But okay, jokes aside. Of course, during these times, we are actually looking at the 7 years of famine, all right? And of course, like what Joseph has mentioned, the net interest margin will be affected, all right, because the mortgage rates will be reduced. In Malaysia has been reduced. In Singapore, likely to be reduced. Okay, so how can the bank makes money? But here we are not so concerned about the next year's profit, all right, simply because we want to build a long-term sustainable investment portfolio. So there will be times where there are times where the economy is doing well, then of course the banks will do well. There are times where the economy is not doing so well, so therefore the banks will not do so well. So when times are good, right, then of course the stock price will actually go up, lor. And when it goes up, then how can I come in and buy? Because it's overvalued, ma. But during times of crisis like this, where we have everything shoot at you, lah, all right, the economic crisis, the political crisis, and as well as the pandemic crisis. So this is where the bank profits may not look so nice and rosy, lah, all right. But for DBS, they have a very strong balance sheet, so they have been maintaining a very strong balance sheet. Because all these Singapore banks are very gassy one, all right? They have learned from the global financial crisis like 10 years ago. So every year they have been very prudent. They have been very resilient with their total capital ratio. So when they can do that, assuming that they can last this thing for quite some time, right? All right, they can ride out through the crisis, and if the economy picks up, then of course they will stand to gain, lah. All right? So which means, from my point of view, I don't buy thinking that it will go up anytime like 1 or 2 years, although it went up. I would say I will buy at a discount, and if let's say it continues to go down, right, then of course I will be more than happy to grab more, lah. Okay? But in the meantime, for the next 1 or 2 years, buy stocks with an anticipation that it might go down in the future, lor.
All right, very good. Next one. Albert.
Mr. Ian, thank you very much for your information. Just like to ask you, since you said about the 7 years of famine, are you more of a fundamental and also you combine technicals, or when you pick the time to buy a particular stock? And what about the sector investing in this 7 years of famine? Is there a sector that you focus on besides financial? Thank you.
Okay, so basically, I will consider myself a fundamentalist. I do not know anything about technical trading. Of course, when I come to Every Nation Gateway, I receive some questions about stock trading, all right, which I do not know how to answer because I'm not into stock trading. I do not know anything about technical tools, softwares, candlesticks, etc., etc. So my way of assessing a stock, to buy or not to buy, right, will come into these two questions, lah. The first one is the accounts, all right, because my own assessment is actually based on the financial accounts. So if the accounts are good, that is very good. Number two, instead of using technical analysis, because I don't use any of them, so I will rely heavily on valuation ratios. All right, so this is actually what I focus on. And I focus them in depth, very, very much in depth. So it's about the financial accounts, the business model, the business, the financial accounts, and the valuation. And when it comes to the sector, right, personally, of course, I have my own preference, but because I'm looking at it at a much more longer term, I wouldn't say not all the sectors I like. So which means, like, for example, airlines, oil and gas, maybe I stay away from them. I like something where it is much more recurring in nature, all right? Something that can actually produces long-term recurring income. So that is actually one of the key things that I will look at. And of course, because of that, I tend to focus a lot on the finance sector, the REIT sector, and maybe, hopefully, if let's say the F&B manufacturing companies, their prices drop, that will be very good news to me. All right, so I like all these boring but very profitable kind of businesses. Yeah.
Very good.
So I'm assuming, Mr. Ian, you are more of a fundamental investor.
Full-blooded fundamental.
Do you use those intrinsic ratios when you pick companies up for your shopping list?
Intrinsic value, okay, good question. So basically, intrinsic value is something that is, I learned this from Warren Buffett, from reading Warren Buffett's book, known as Buffettology, okay? And he has actually give out a formula on how to calculate intrinsic value, okay? And all these things are actually based on cash flow, which sounds very logical, but of course, sometimes, as good as this is, right, this intrinsic value, you can't apply it on, let's say, banks. Because banks, the cash flow from operations, right, it kind of varies, all right? And it doesn't actually assess the performance of, let's say, a bank like DBS. Why do I say so? Simply because if you look at the bank, right, every day, everybody does transaction. Everybody put in money, take out money on a daily basis. Nobody knows. So that means to say it's not the bank's fault that people take money out from the bank. People take money out from the bank because the people needs the money. All right. So that's why you cannot use this on banking stocks. Okay. So that's one way to look at it. And what I would say is this. Okay. For intrinsic value, it's an estimate. Okay. It's just an estimation of the value. So let's say you have calculated. All right. Let's say you calculated a stock where the intrinsic value is $20. It's just an estimate. It's not to say when the stock will actually hit $20. It doesn't work that way. But rather, if you go with dividend yields, that's cash flow. Once you buy it, you get the dividends, it's cash. It's cash returns. It's more reliable than estimate level, a value that is estimated. Yeah.
Based on your portfolio, do you also sometimes, because invest, because like something is going to happen in US, let's say the election, do you also focus on bonds and forex?
No.
Okay, we're about done. But before we go, I really have one last question for you, very quick one.
Okay.
It's interesting. You started off your presentation with the story from the Bible. But every time when we read the Bible, people always say it's just holy, holy, holy stuff. How did you manage to see investment and money and yields and all that in that?
Good question. That depends on the Holy Spirit, but that jokes aside, of course, I come in from the point of view as an investor. Of course, if you read this story from a, let's say, for example, as a child's point of view, let's say you learn this in Sunday school and you do not have the accounting background or the investment background, then of course you will be reading it as a Sunday school material. But today, after I have actually studied accounting and I have actually went through investing, have some experience, then I read back the same story, then of course, it reads to me in a different light. Let's put it that way.
So you would say that the Bible is really very rich, right?
Yeah.
I mean, I think we should first read the Bible before we read all the other stuff in the market.
Yeah, of course.
All right. Okay. All right, good. Thank you very much. Can we just give Ian a big round of applause? Those of you who are watching live, love. All right, do it now. Thank you.